Hey everyone, welcome to the Real Estate Investing War Room Live. I'm your host, Ryan Tennell, and we are joined by a seasoned expert in real estate investing. Our guest today has an extensive background in multi-state acquisitions, asset management, leasing, development, and debt transactions spanning several decades. His experience started decades ago, building nearly 100 million of residential and commercial property in Delaware. And since then, he's been a part of 3 boutique real estate private equity sponsored firms that went on to oversee $1.6 million of commercial property spanning from California all the way to New Jersey. And he's currently the founder of Nexus Private Capital. And we're very excited to learn more about him and his expertise in hard money lending. So this is Cort Chalfant. Thanks so much for joining. And glad to have you on.
Well, thanks for the introduction, Ryan. It's very kind. Hello, everyone. I can't see you, but I think you're there. I know you're there, and looking forward to being a resource for the crew tonight.
Excellent. So, I'd love to just kind of get started and tell us about, out of everything that you could do in life, why did you decide real estate was the way to go?
I didn't have a choice. I was born into a family business, youngest of 4 kids, and my parents decided we were all child labor. So we started tarring foundations at age 6. And from there, learn the trades by 12, 13, running crews, 14, 15 years old. And finally out of the dirt for the most part by the time I was in my early 20s. So I've been flying a desk for most of my career, but started out in the dirt.
Well, I mean, that's a great way to get some hands-on experience. So you have a very extensive resume. It sounds like you've set records at every employer that you've been at, pretty much through your whole career. So I'd kind of love to dig into that and just say, like, out of all these places, what were you setting the milestones at, and how are you doing so well at every company?
Sometimes it's better to be lucky than smart, right? That's a quote from my old boss, and it still makes a lot of sense today. So there's no question that over the career I've been the beneficiary of some up markets. But really, I think of all the different things we've done some things. But taking a 3,000 acre piece of land, 15 miles south of Tucson, Arizona, scrub land with no decent features whatsoever, we got that entitled for 10,000 homes, and it became the 8th fastest selling community in the country. That was an amazing ride, and that was from 2001 to 2012. It set the stage for my travels here to Texas, since I got plucked out of Arizona to go do it again here, specifically in Bastrop, as well as a project in Albuquerque, New Mexico. So Rancho Cerrito was an incredible ride, mostly because it affects people's lives. When you build a small town, as we did, where you're literally building churches and schools and roads and parks and water parks and shopping centers and truly even municipal complex and hospital deals, basically in the middle of nowhere, create and deliver everything that a young husband and wife, probably in their 30s, pushing a baby carriage along the Paseo next to the water. And it kind of dawns on you that their entire living environment came out of the head of 2 or 3 people. It's a pretty humbling experience. So that was a heck of a ride, and great lessons learned, and a great source of pride as well.
Yeah. So what was your role in the whole project, and like what was kind of your day to day? Like what were you in the trenches doing?
Yeah, in that case, I was senior VP, so I headed up a 10-person executive team, answering to the owner of the company. I was director of strategic planning, so I developed the entire commercial plan for the project and developed the financial model that would dictate where you build what when. So, in a project of that scale, it's about $20 million of infrastructure in any given year. So roads, parks, sidewalks, landscaping, developing what we call super pads for mostly national builders to build single family residential homes on. So, director of strategic planning, you're thinking about what to deliver when and how to finance it all, where different kinds of land uses should go, whether they be parks or commercial or municipal facilities, water company, sewer facilities.
Yeah, I think it cut out just at the last second there, but yeah, I mean, you're directing entire teams. Like it's a huge operation. Like I can imagine the amount of weight that you must have felt working through all those, and every decision obviously affects your livelihood and your family, but all the employees you're working for, and all the residents that are going to eventually move into these 10,000 homes that you built. So enormous amount of scale and weight on your shoulders. So it sounds like you were the man for the job. I'd love to learn, as you're going through this project, that's so much to take on, and that's not what you're doing right now. So was there a day that you decided to make the switch to go from development into private capital and private lending, or was that kind of a slow process?
It wasn't a slow process. It was more accident than anything else. I got recruited to develop an 8,700 acre project in Bastrop, Texas, just outside of Austin. That recruitment was by a group that had been spun out of Robertson Stevens Investment Bank. Two guys had spent 9 years getting 8,000 acres entitled for 10,000 homes. They finally got it entitled, but they obviously had never done a master plan before, of certainly that scale, whereas I had. And so they brought me to Texas, found out their executive team, and do it again. Literally 8 days before I landed in Texas, the CEO of our company got a certified letter from the largest investor in the project. That was an investor who had $55 million in cash invested, had been there for basically 9 years. And the gist of the letter was, "Hey, Jim, now that you got it all entitled, thank you very much, and we'd like to take it from here." So those two spent about 2 years legally fighting each other over that issue. That happened literally 8 days before I arrived, but I met my wife here. That locked me into the Austin, Texas market, and but for her, I would have gone right back to Tucson, Arizona. I have no network here, and I found myself at age 51 looking for a job in an environment I had no network in. I have a pretty scary resume. I've been highly compensated, and I crossed that imaginary line about too old or too this or too the other. So I got pushed into lending, kicking and screaming, from a family in Arizona I'd done a lot of deals with over the years. They said, "Hey, Cort, you got time on your hands. Why don't you put some of our money to work in Central Texas? We love the market." I thought they were talking about buying shopping centers, which was a big portion of my career, was acquisitions of office, retail, and industrial properties from New Jersey to California. So that's what I thought they were thinking, but it turned out they were talking about making hard money loans. And I was shocked. I'm like, that's not going to work. How many $200,000 loans do you have to make a living? I didn't think it was a scalable business, and I didn't like the reputation in the industry. So I told them no, and they said, "Well, we'll allocate $2 million. If something comes along, we'll back you on it." And the no turned into a yes when, by accident, basically, I had a hedge fund guy out of Houston. He did a loan in 6 days on a brand new property he had built, second home on Lake Travis. So we got into the business by kicking and screaming, professionalized an offering in early 2017, and then launched the fund in April of 2017. And it's been just, a very solid ride since then.
Yeah. And how do you go about finding your clients, or how do they find you if they're looking for these loans?
Yeah. So really, at the end of the day, we're a matchmaker. We're a matchmaker between investors who are seeking yield and safety. They're honestly, we offer our investors 8.5% fixed coupon with monthly distributions. And it's secured by first deed of trust on principally small balance residential loans, so a lot of diversification, and other layers of safety as well. So for accredited investors seeking yield and safety, where do you go to get an 8.5% coupon? Junk bonds? That's not my idea of safe. And by the way, nobody holds a bond to maturity, which means you always have pricing risk. So our job really is to match up investor capital. We use investor capital to originate short-term loans to mostly, but not exclusively, residential fix and flip investors. And so, our borrowers, all of our borrowers are what? They're seeking capital. They're small fry. Where do they go to get $100 or $200 or $300 or $400,000? They have no idea. They're going to go to a hard money lender, because where else can you go? Conventional banks won't finance it. They can't, for regulatory reasons, for the most part.
You
certainly can't go to a conventional.
Sorry, Cort, you're saying the conventional loans can't finance. Yeah.
Yeah, conventional loans cannot finance the product because they're dealing with a standardized federal form. And if the house requires more than a relatively modest amount of work, it's not going to qualify for a federally backed loan. So conventional mortgage lenders cannot finance this product. And that's the single biggest reason why hard money guys exist. The second is speed. Our entire industry is predicated on moving quickly. Conventional loans, are done in 45 days, let's say. Our fastest turnaround is 3 hours and 15 minutes. I kid you not. We
That's incredible.
we routinely work in the 3 to 10 day time frame. Probably, 60% of all of our loan transactions, start and then fully funded within about 5 to 7 days.
Yeah, and so I used to work in the conventional mortgage space, and we were proud when we could do these 30-day turn times, but I would say, yeah, on average, 30 plus is probably more realistic, and especially nowadays when they're tightening regulatory belts. So, we had a lot of loans in various stages of the process. There was a lot of headaches on our end as originators and on the borrower's end, where there's the stress of buying a home and all these other things you're juggling. So I can imagine the relief that you feel when you have a phone call with you. You probably have 3 or 4, check boxes that are going through that you got to make sure, hey, we got to meet all these requirements. But if you can do it relatively quickly in a matter of days instead of weeks, it's a weight off of everyone's shoulders.
Well, it's actually more than 3 or 4 check boxes. All the things I used to apply in sophisticated deals, substantial deals for commercial properties, or everything that you would go through with a regular conventional lender, we do here in our underwriting. So we're talking about personal interviews, a property tour, evaluation of bank statements, tax returns, background check, credit check. We're doing the entire program literally in hours or days as opposed to weeks. So, I'm a decision maker. We have the capital. I don't need to go to a third party committee or anything else. If it meets the parameters that are established by our private placement memorandum, our lending parameters, and if it meets the stink test and our underwriting, we can execute in that deal extremely quickly.
Yeah. And do you get people that just throw all kinds of deals your way, or do people typically have an idea of what to expect when they come talk to you at first?
Yeah, most of our clients are pretty relatively seasoned. And what I mean by that is, we have a lot of repeat business from established clientele. There are newbies that come into the business and they're infatuated by a program they saw, or they think it's easy money, or they know somebody who this or that, and they need coaching up. A lot of lenders will pass them over if they don't have experience, and we may or may not, depending upon their coachability. We'll give them tools to be successful that others probably would not. And just depending upon how receptive they are to certain things, they may get funding from us. We may ratchet up our requirements, but fundamentally, our borrowers tend to be repeat clients or referrals. And so they're already tuned into the industry and how to underwrite properties and so forth. We don't get a lot of, junk.
Mm-hmm. Right. So I'm asking, there's a lot of people that would love to be investing in real estate, and they watch HGTV and think it's easier, like you said, go through a coaching program and say, I could probably do this. And let's say there's a couple comparable houses. In Austin, the average home price is about 500,000, or it was. Maybe it's changed a little bit since then. And you've got a couple borrowers and a couple different houses that they're looking at the same price points. What separates a good deal and a good borrower from something that would be scary that you would decline and say, we're not going to do this deal?
Yeah, well, a good borrower is going to be somebody that has been there and done it. They have realistic underwriting. They have a crew of their own or trusted contractors that they've used before and they can rely on. That's really important. Likewise, they are probably not doing a venture for the first time with another partner. If they have another partner, you want to see that they've done a bunch of deals together, not their first ones. We find that partnership problems can lead to defaults that are problematic in a way that are unrelated to the real estate. So you want to get people who've been there and done it together if they're partners. You get a lot of husband and wife teams. Honestly, if somebody used to work for Dell, they get tired of the management world, they're going to go off and be their own flipper. They love it. They're their own boss. They could design things. They get to build things. There's tangible results. They're excited about their business, what they do. And when they execute very well, you can definitely make money. The one thing about the flipping world I would caution everyone is don't think in terms of one-off asset. You got to look at this in portfolio theory. So for every 10 deals you do, you're going to have one that you tell all your friends about because it was a home run. You're going to have one you don't tell any of your friends about because you took hits on it. You're going to have a bunch of singles, maybe a couple doubles or a triple, and that's it. That's your portfolio. And so it's a bread and butter sort of take your lumps with taking your highs, and just look at it as a regular business. And the really good borrowers, they tend to work in very specific neighborhoods. They know those neighborhoods very, very well, and they've got their own crews, as I said. They're realistic about their pricing and expectations, and off they go. We love them.
Yeah, I can absolutely imagine that. So I guess as from a risk standpoint, if an investor was going to come in and say, okay, hey, I'll invest in the fund. I want to be part of the team lending out these loans. Like, we don't have to do any work. Conceivably the
Right.
borrower has some equity in the deal, so it's a lower risk setting than they're taking on. What are some of the loan to values or some of the risks that you guys analyze when you're looking at deals
Sure.
like this?
Yeah, so we're in a bucket with a lot of lenders where we cap our loans at 70% of after repair value. So we can lend up to 85% of the purchase price. We'll hold back dollars for expected construction costs, so a budgeted construction cost. But when the project's done for a given level of finish, we can estimate the value. And that's pretty high probability estimations, at least historically. It's a little bit trickier today in the down market, but historically it's pretty simple. Residential single-family homes can be adequately valued using a comps approach, comparable properties. And, plus or minus a relatively tight range, we have issues, maybe it takes a year and they end up just breaking even. So I hope that answers the question. 70% loan to after repair value.
Yeah, absolutely. So I've got a follow-up question for that, which is, out of the portfolio of all the deals that you've done, have you had a few that you guys have had to take back from the borrowers or that ended up going into foreclosure or, some horror stories on the investing side?
Yeah, and sorry about the lights. It seems to time out in here, so I'll just keep flicking it on and off as need be. Yeah, we've taken back a handful of properties and we've done about 1,000 originations. I don't know my exact count right now. We've taken back somewhere around 16 properties, I think, over the life of our fund. So you can do the math on that. It's pretty healthy. Net, we've made money on the foreclosures, but there have been some we've taken hits on. That's the luck of the draw. There have been some loans that we wish we didn't do, and a lot of loans that have been really secure and great. And every one you take back has a seemingly very unique story,
Mhm.
So, but historically, it's been a really low default rate. That's
Gotcha.
changed. That's changed here recently. And I know all the lenders in town. Frankly, we talk, for the most part, and everybody is feeling more default, more delays in payments, and stretched out cycle times and so forth. The structure of a fund becomes very important at that point to see if that fund manager can power through or not.
Yeah. And so if you guys do have to take back the property at that point, do you just, list it on the MLS as is and get the highest price, or do you get your own crew to go out there and finish out the renovation plan?
Yeah, it depends. There have been cases where I say, hey, let's just wholesale this thing right back out. Call up New Western, talk to one of our friends there and say, hey, we just took this property back. I really don't want to make any money. I don't want the distraction. I just want to unload it. You guys want to market it? Boom, it's gone.
Mhm.
There have been other cases where we say, hey, I think there's some pretty good juice in this deal. Let's go ahead and spend the energy. It's got enough scale and to be worth our time. Let's go ahead and invest the time and complete the improvements and cycle out of it. There have been other cases where we take back a property, we turn out to be underwater. We can't get out from under it no matter what we do. And we say, okay, let's go ahead and take a hit on it and just unload the property and take a short-term loss and move on. So it's all of the above.
Hmm. Yeah, I would say that makes sense. And, that just kind of comes with every business, right? The majority of time, hopefully you're making a profit, you're doing some good deals, but there's, real estate's not without its risk, right? Any kind of investing is risky. Note and lean investing like that comes with its own risks. So
No question.
yeah. So I would guess, if I was an investor or there's potential investors that are looking to come into this, they're aware of what hard money loans are, they're aware of flipping, one of the questions I would think is they'd say, well, what's the profit margin? You're paying, 8.5% to these investors. And then, obviously Nexus has to make some money as well. What are some of the rates that you guys are lending the money
Sure.
back out to the borrowers at?
Yeah, on flip deals, we're lending at 11.45% plus typically 2.25% origination fee. So 11.5, it's easier math, plus 2.25, it's basically 13.75% effective if it's a 1 year, if the money's out for a year. Most of our loans, as I said, pay off before a year. And let's just say if they pay off in 9 months, then that 2.25% origination fee, if I take that and divide by 0.75, it'll give you the effective, which is 3%. So 3% on top of 11.45 is 14.45. Now we're paying our weighted average cost of capital is about nine, little tick over 9%. So you've got a spread of around 300 to 400 basis points in there.
Yeah, absolutely. Yeah, it's healthy enough to keep the lights on, and when they're not automatically coming off. And
it's a scale business. It's a scale business, for sure. But yeah, there's enough there for us, for sure.
Excellent. And I mean, these dividend checks, if you're an investor coming into the fund, is it just, do you pay out monthly, quarterly? What's the variability?
So in our case, we pay out a fixed 8.5% coupon. We make monthly distributions. Our distributions are 100% from profits. It's not funny money. We're not talking about, bringing in subscriptions to meet payout requirements. So from inception, we've paid out like clockwork to our investors on a monthly basis.
Yeah. Do you guys have like minimum investments if you want to come and join?
Yeah, the minimum is $25,000, and we have very few investors at that level. It's about 177 or so investors in our fund. We've got about 110 million of equity. So you can kind of do round math in your head and figure out that most people are bigger than that. But yeah, what we do find is that people might stick their toe in the water at a relatively small amount just to make sure it meets their stink test. And then lo and behold, guess what happens? They turn around, they're happy. And we have extremely tight reporting. We put out quarterly reports like clockwork, extremely transparent and detailed. We've got audited financial statements, so that gives them some comfort. We're the only fund that I know of literally in the entire country. There might be others, but I'm not aware of them. I probably would be aware of them because I've been, significant roles in the large trade organizations and so forth. But we're on the Fidelity Investments as well as Charles Schwab alternative investments platforms. So any registered investment advisor for either Fidelity or Schwab nationwide can find our fund listed as an authorized investment vehicle for those advisors. So you don't get there unless you can withstand some pretty heavy scrutiny, and that brings comfort for our investors. So yeah.
Excellent. So if you are with Fidelity or Schwab, would they, have to contact you directly and do like a private placement with that, or could they just?
If you've got a wealth advisor, so for RIAs, registered investment advisors, if you went onto Fidelity or Schwab's retail platform, you will not see us. If you're working with a wealth advisor, they have a separate platform for their wealth advisors to access investment tools, and we're registered on both of those. So yeah, you would work with your wealth advisor. You say, hey, I heard about this thing called Nexus Series B. Can you put me in it? That's if you want to use funds that you have currently invested at Fidelity or Schwab. If you don't have to use them, but some people do. Even if you have an account at Fidelity, you can just work with us directly. It doesn't matter to us, and it probably doesn't matter to you as an investor. It might actually be easier working with us. There's one less layer. There's no commissions. We don't pay those entities any commissions, none, zero. Because those wealth advisors are working under some fee arrangement already with their clients. And so this is not a commission trade. It's just a tool that their wealth advisors elect to suggest that their clients use.
I gotcha. And then if somebody comes in for, let's say 100K, do you guys have a period where it has to be in the fund for a minimum amount of time?
Yeah, we offer two options. You get an 8.5% coupon with an 18-month lockout. So in that case, you can't redeem for 18 months. If you want to redeem after that, and very few people do, then just send me an email. And typically, if it's that level, we'll give you a check, we'll direct deposit to your account the next day. Or option two, you can do an 8% coupon. And at that case, there's no lockout period at all. You invest today, get out tomorrow. No problem.
Okay. Yeah, no, totally makes sense. So let's say someone was coming in and, there's so many options for investments out there, right? They could invest in your fund. They could do, like you were saying, the treasury bills or junk bonds. They could do the stock market. They could invest as an angel investor in their friend's business. what's the mindset of the investor when they're typically coming into something like this?
Yeah, I mean, our whole program is yield and safety. So where can you go in the market for an 8.5% coupon that is safe? Now, in investor speak, I have to be very careful of using the word safe. So it's a qualifier. You need to say, okay, so what you have to get into it. Why? Tell me what the layers of safety are, and then you have to make an assessment. And I can rattle them off, but I want to bore the whole crew right here. But in short, small balance loans, heavily diversified, first deed of trust. For every 70 cents we lend, there's $1 of tangible assets backing it up. Manager takes no fees, zero. 100% of the money goes to the fund to cover distributions to investors. And only after those distributions are satisfied does the manager make a nickel. That is unheard of in this industry. So basically, we put our money where our mouth is. We have our skin in the game. We've got $1.3 million invested in first loss position. So that's a buffer for our investors. If I do a bad loan, guess who eats it? I do, because my money's in first loss position.
Yeah.
Then there's nuanced items. There's 3 of us that own the company. Our largest investor has somewhere around 17 million invested. It's the same one that pushed me into the business. He pushed me into the business because he wanted that. They love secured loans for the family. And what they had in me was an asset manager where there was a lot of trust and a lot of history. And so basically, this was originally a vehicle for their family to have a secured investment that delivered a coupon like clockwork. And then we just expanded it by making it available to a larger audience, a larger investor network. So, there's a lot going on here. So I would challenge anyone, where in the world can you go in the market and find an 8.5% coupon? I mean, pick an investment. What's it going to be? You'd be hard pressed to find it.
Yeah, and I would say if you try to buy some Apple stock, I don't think they are going to put their capital up before the investor loses their share price. So
they won't. You're dealing with volatility. That's a big thing. I mean, investors here, and I don't need, this is not a promotional thing from my perspective. We move to a different topic, but you come in at 25,000 a share. Your share price does not vary. It's fixed at 25,000 a share. So when you exit, you get your 25,000 back. The only reason you invest in our fund is because you want the coupon and you want the security that goes with it. That's it. You're looking for yield, safe yield.
Gotcha. So if somebody has, like a retirement account or 401k, can you use those dollars, or does it have to be after tax?
Yeah, absolutely. So you can invest those dollars both through Schwab and Fidelity, but we're also an approved investor from about 9 other different trustees. The typical vehicle, so that's Pensco, and they're all on our website. There's a bunch of them. So what you would typically do is set up a self-directed IRA, transfer money into that, and then the custodian for that IRA will invest it directly in our fund. And then the custodian will be sending the distributions to the custodian as well as reporting and so forth. And that's how that works. Easy peasy.
Gotcha. So you had mentioned, I mean, obviously nobody wants any foreclosures on their books, but this, last year or so in the real estate market has been quite turbulent. So I'd love to get your opinion on what you're seeing out there day to day on, the real estate market in general. Specifically, we're here in Austin and Texas,
right?
And where do you see things? I guess we'll say, what have you seen in the last 12 months, and then we'll talk about the future.
Well, a lot of shell shock, right? A lot of shell shock. So you see properties that are not getting, obviously the day of getting, 15, 20 offers, and half of them are cash offers and at inflated prices. All of that's gone. It's probably gone for the rest of my career. I just turned 60, so I think I can say that, whereas perhaps some of the audience hopefully doesn't have to say that. But those days are gone. So you can now expect longer days on market. Borrowers should be thinking about that when they're doing their underwriting. So they have to bid lower prices in order to offset the carry costs. There's no question that you've got a shell-shocked world out there that either can't afford to purchase now. I did a pretty heavy analytical effort in June of last year. I would say probably 45% of the home buying market that existed 18 months ago would not be in the market, cannot afford to buy today. So the rapid rise in interest rates has had an enormous impact. An average, mortgage payment going from around $1,300 to about $2,600 is the effect. People's incomes have not done that. So, smaller universe of buyers, there's definitely been downward pricing on homes, 20+% in the last 18 months, definitely. Fewer offers, longer days on market, people pulling their houses off the market. Whole new concept now, lock-in. Typically a buyer, a home buyer will sell every, 1/6, 1/7 of all home buyers will sell every year. You don't have that right now because many people in the many homeowners have a low cost mortgage, 3.5%, 4%, and they don't want to trade out of that mortgage and go up to a 7, +% mortgage today, double their payment for a smaller house for the same size house. So people are they currently use, and there's a couple of them. We're a very positive market overall, net immigration.
Well, absolutely. Yeah. And so with the Fed mentioning that, they're going to reduce rates in 2024, and we've seen the 10-year Treasury come down in the last, month or so, what does that change about your business, and what is your thoughts on how investors should look at the real estate market as a whole?
Honestly, it doesn't change anything. We tend, I'm a bit of an anomaly. Nexus is a bit of an anomaly. We think defense first, not offense. We're less interested in how much money we're going to make. We're more interested in making sure we don't lose what we have. So we think defense. I don't think that policy coming out of Washington is consistent currently with the expectation of lower rates going forward in 2024. So we're going to behave as if they're not going lower. Okay. And so we're just being careful with lending. We're working very closely with borrowers to help them as best we can during these times. And when we see actual material significant improvements in the market, then maybe we will lend more. We'll be more aggressive with lending. And then what I mean by that is just more active, because we're pretty quiet right now by design.
Yeah. So transaction volume I've seen is down, 70, 80%, from this year compared to the previous year. And that's affecting everyone, realtors, lenders, everyone that's involved in any aspect of real estate. With, like you said, a lot of people have locked in interest rates at low 3%. And it's, why would you trade that out for something higher? Do you think there'll come a point in time, if rates don't come down, that people just decide this is the new normal and they'll eventually trade up and we'll see more of an equilibrium, or what do you think is,
Absolutely.
the next step? Yeah.
No question. In fact, historically, it was 2001 when rates really started going down to, crazy low levels. Prior to then, and I can say this because I've been, building things and doing deals since the 70s, the normal was 6.5%, 7.5% interest rate. So there's a group of folks out there. At some point, they're in lock-in mode, don't want to give up their cheap mortgages, but at some point they're going to have to. Jobs, life. Yeah, I do believe that even if I don't ever expect rates in my career to go into the 3% range again, hopefully they'll settle in a 5-6% range. That would be phenomenal. But it's important to remember that historically rates in the 7% range were normal.
I gotcha. So do you own any real estate personally, or do you just invest in your fund?
No, we've got real estate. My wife's got 21 rental units. I've got 1, 2, 3 other properties other than the primary home. So yeah, I've got real property. You looking to buy some?
I hear there's a lot of opportunity out there if you know where to look. So yeah. And is your philosophy when you're buying these investments, are you typically looking for long-term holds or something that's low maintenance, because a lot of your expertise is in your day-to-day investing job?
Yeah, well, with my wife, it was interesting. We first met 9 years ago. She had just bought her first rental property. It was a single-family home. It was brand new D.R. Horton home, and it was no maintenance required. And she put a renter in there for $2,100 a month. And we changed her perspective and said, hey, let's go buy duplexes. We're, at $250,000, so the same price you paid for the single family home. But on a per unit basis, your basis is half of what you put into the existing home, which means that your renter can pay less than $2,100 a month. In fact, they tend to pay around, let's say, $1,300 a month. And 2 times 13 is 26, which exceeds 21. So a better yield per unit, a lower cost per door, higher maintenance because it's an older product, but a much, much, much larger universe of renters, because a lot more people can afford 1,300 than 21. And the $1,300, I'm using this as an example, renter will tend to stay, whereas the $2,100 a year renter will tend to cycle out after 12 months. They could afford a mortgage. They're in a temporary holding pattern between purchases or whatever. They tend to leave. Now you have to do paint and carpet and you name it. Whereas a 1,300 universe renter, there's a plethora of them, and they tend not to leave because they're never going to be able to afford the purchase of a unit. So from a defensive strategy, get a theme here, we tend to think defense first. We would much rather be able to appeal to the fattest, most pregnant piece of the market, where there's a lot of consumers that can afford your product, in this case, a rental unit. And so that's what she did. She ended up buying 10 duplexes and still has the original rental property. And it's been a phenomenal, phenomenal deal. So today you can't do that. We bought at a time, market timing right, so better to be lucky than smart. The average price of her acquisition was probably around 290,000, times 10 units. Today, you can't buy a duplex for anywhere remotely close to that. And whereas a single family home is doubled in value, but those duplexes are easily that. So it's been a really good strategy for her. We would target a yield, that's north of interest rates. Back then, interest rates 3.5%, 4%. She's getting a cap rate in the 6.5% range. So there's a couple hundred basis points of accretive value. Today, if you're doing that, your cap rate's a 6, or a 5 or a 4, and your cost of capital is a 7. You're upside down. So you can't acquire on that basis. It's very hard to acquire rental property that's making sense by our standards today.
So when you look out there and you see, it's difficult to buy anything that cash flows with where rates are and where prices have gotten to, but
right.
There's a lot of different things going on out there. Where do you see opportunity if someone wants to, invest? Is what do you see as the best place to get into?
Yeah, well, anytime there's a down market, and especially people who have borrowed a lot of money in the past, they've got challenges, right? They're dumping property. In a down market, you'll see acquisition opportunities. So it's a contrarian approach. People who have dry powder, who are able to come in, and they have the intestinal fortitude to come in when people are fleeing, there are good opportunities. So it's a more of a value add or an opportunistic play as opposed to an income play. You got to be willing to come in, acquire it, sit on it, wait for better days, and there will be better days, because real estate is very much a cyclical business. And we are definitely in a market with the rising tide. And the influx of bodies improves values for real estate across the board, whether it's retail, office, industrial, residential, whatever. The increase of bodies creates demand for real property. So yeah, if you've got the intestinal fortitude, sniff out deals. There's more foreclosures now than there have been in many, many years, and just distressed buyers out there, and go for it.
I hear you. Well, you've been having a long career in real estate, and you've been running Nexus Private Capital for a while. And, is this a passion project? Are you going to keep doing this far into the future, or what's on the horizon for you next?
Yeah, no, this is all I do. I love it. We've got a great team here. Everybody I work with is, awesome. Everybody's cross-trained. It's like a family. It's more than a job. We have fantastic borrowers. We have extremely happy investors, and that's a source of pride, So for us, it's profitable. We do it the right way, I like to think, and that makes you feel good, right? And so I don't really have any great need to go create anything bigger than what we have, which sounds kind of unusual and is. But frankly, we just like to keep all the balls safely in the air, keep our 2 main constituents happy, 3 if you include myself and our staff. You keep the major constituents happy, feel good about that, keep going.
Great. Well, I'd love for people to learn, more about you. What's the typical profile of someone who does come into the fund? Is it someone, right out of school, someone retired? Who are typically people that like to work with you?
Most of our investors are sophisticated, successful professionals. Many of them are deal junkies themselves. Okay, so opportunistic investors that invest in a range of things. Many of them have, a sizable portfolio, and they put a portion of their assets here as part of an asset allocation model. because they have plenty of equities or plenty of this or that, but they have relatively few yield scenarios. We do have quite a few retirees that literally live off the coupon because it's a fat coupon and it's extremely reliable. So I mean it's really it's awesome for them. So that's a typical investor is sophisticated, highly educated, substantial wealth. Many times they have advisors, and this is just one portion of their portfolio.
Excellent. Well, that's great to hear. Well, for those who are listening, if that fits your boat, what's the best way to get a hold of you if they're interested in finding out more?
And you can always call me. My number is 512-230-9867. My email is cort@nexuslending.net. So it's a .net, cort@nexuslending.net, and Cort is CORT. Or just Google us online, Nexus Private Capital. Our website will pop up. We answer the phone. You'll find my personal phone number on the website. God bless.
Yeah, I've agreed. Having your personal phone on there is the best way to do business. Surprising how many people just don't even answer the phone these days. So absolutely. Well, very good. We're getting to the into the show here. Before we take off, is there anything else that you want people to know about you or everything going on in your world?
I really don't need to talk about myself. I'd love to answer people's questions, give them some value for the time invested, and we'll take our best shot at their questions.
Definitely. Well, we got this recorded. We're going to be passing this out and distributing this for anybody that wants to get a copy later. So appreciate you guys tuning in, and reach out to Cort if you guys have any other questions. Thanks.